Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Sitting in the podcast with me today is the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul.
So today we learn going forward by talking with people that have been there. I want to talk a little bit about the history of real estate finance for the last maybe 30, 35 or 40 years. I mean, I've done this for 38 years. I found somebody that has done it for a little bit longer than I have, by maybe about 5 or 6 or 10 years longer. And he has a great perspective of investing. Now, I didn't know this gentleman, but I competed against him when he owned a firm called COHEN Financial. COHEN Financial, they were based out of Chicago. They were a nationwide firm. They did all kinds of financing, small deals to large transactions. They did CMBS. We would see loan documents with their name on it all the time. And he has a great perspective, and I want you to kind of listen and take some notes, a little bit about the history of real estate investing, because if you've just been in the business for the last, say, 2 or 3 or 4 years, you have probably a good idea, but you don't have the well-rounded idea of what financing of apartments or investing in real estate is all about. This gentleman wrote a quote that I thought was really good. And he says, commercial real estate is not coming to an end. It's really back to basics. Fundamentals matter. Who wrote that? Jack Cohen. Jack Cohen, thanks for being on the Old Capital Podcast. We certainly do appreciate that. Can you spend just a few minutes and talk a little bit about your background, about where you've been and how you've done, and tell us a little bit more about you?
Well, Paul, and I really appreciate the opportunity to sit with you guys and your podcast. Very kind of you. I'm the old guy on the call. I started in the commercial real estate finance business in 1981. I've made 3 great mistakes in my life. First one was going to work for my father. My dad created COHEN Financial in 1978. I graduated college. I'm a civil engineer undergrad and construction management master's from Stanford, and undergrad in what they called management engineering from was then Claremont Men's College, one of the 5 Claremont colleges in LA. I ended up going to work for my dad, second job. My dad, I joke, shouldn't have had children, let alone children in business with him. But I did enjoy the business. COHEN Financial was a local mortgage banker. My dad created a business in 1965 called B.B. Cohen & Company, which became Heller's real estate business. Heller International became Merrill Lynch. Merrill Lynch became B of A. There are derivatives of Cohen family real estate coming out of Chicago for a lot of different weird places. I have a brother Bruce, created a business called, after we were in together for a period of time at COHEN Financial. We had a principal agent and advisory business at that time, and we spun the principal-based business off into Wrightwood Capital, which became Ares Real Estate Business. And Bruce today has a business called Temerity, where he's raised a bunch of money to invest in co-GP capital for operators. What was interesting about joining the business in 1981 was, long-term interest rates were 16 and 17%. Prime was 21. Unemployment in Rockford was 22, and my first assignment was to convert a small apartment deal in Rockford, Illinois, to a condominium right in the middle of that. As you might expect, we died with that project. It took me 2 years, 1983, before I did my first deal with a company called Equitable of Iowa, which today is owned by Voya in its journey. So I was a commercial mortgage banker. COHEN Financial originated loans, serviced those loans for these life companies, and the business has obviously evolved. In the early days, the business was exclusive correspondence. You couldn't access John Hancock in the Chicago metropolitan area without going through COHEN Financial. but you had to go to Heitman to get the teachers. You had to go to Draper and Kramer to get to Aetna. That's certainly not the business. As the 80s started to play through, we had a vibrant marketplace, but this was a marketplace that thrived. The reality was negative leverage. And it's interesting because Michael Milliken said in the mid-80s that negative leverage works if it's on assets that are appreciating. That's a lesson for our future. Right now, we have negative leverage, or the marketplace we went into, but I own the judgment we were in like a 2006 vintage where we were at the top of the marketplace with valuation because people were confused the value for price. I'll come back to that later. Up until the late 80s, most of the capital were life insurance companies. It was the late 80s and early 90s. The capital markets came, and when I say capital markets, I don't mean investment sales. That was the securitization world. The conduits, eventually those, created CLOs, CDOs, SASB, all of that evolution did not exist. In the 90s, we had issues around overbuilding, weak tenants. We eventually had the Asian flu. We had the Russian ruble crisis. At the end of 2000, we had Y2K, where everyone thought the world was going to come to an end because all our computers wouldn't know how to go to 2001. What happens after 1999? The capital markets ebb and flow. Who's in them and who stays in them and how they grow changes. What seemed to never change is those who had relationships survived. Those who could adapt survived. I used to say that what you needed to do was to be multilingual. Could you speak to brick and mortar as well as you could speak to the capital markets? I have a thesis about risk in that there are three cycles when we're looking at a real estate transaction, there are three cycles. There's the cycles of an economy, there's the cycles of a capital market, and there's the cycles of the property markets. And in various times, like in the 80s, you had a very geographic, concentrated marketplace. We had rolling recessions, the upper Midwest, the South, the Southwest. It evolved. But if you think about that, property markets, capital markets ebb and flow, economies ebb and flow. When those three cycles come together, you have opportunity. When they diverge, you have risk. So my view is the economy is solid. The property markets are solid. We don't have any of these historical issues in the marketplace that we used to have in the past. What we have is, because of greed and stupidity and easy money, we have overfinanced assets that need their capital stacks rebuilt, and what they really need is time. And here, I think, going into 25, 6, and 7 are going to be great vintage years because people are getting washed out of the business in 2024, and assets are being repriced because the marketplace has lost a sense of intrinsic value, but rather the marketplace focuses on my cost of capital and what I can afford to pay. So there are assets that have intrinsic value. No one's thinking about that because they're thinking about their capital structure. So my view of the answer to the final exam is sponsors who know what they're doing, amortization. This idea of interest only is really, really, really dumb. And most importantly is long-dated equity. When I came in the business in 1981, families were creating and transferring generational wealth because they held assets for decades. And the eighth wonder of the world is refinance. What happens when you increase the value of a property and you have amortization is you go get another loan and you take capital out tax-free and you use that money to invest elsewhere. And then you move on to your next project. That has gone to just before the recent meltdown. People were thinking about real estate as a trading asset, 2 to 3 years in duration. And the reality is too few sponsors could execute a business plan in that time. So people are going to have to start thinking about asset hold 7 to 12, 15 years. How's that for a mouthful, Paul?
Holy cow. A lot of great information that comes out of there. James, a question or two coming from you.
Yeah, I mean, in let's say 21, 22, a lot of these deals got bridge loans that were 3-year, 2 1-year extensions. And so everyone thought 2024 was going to be the year of the reckoning, but nothing's happened. Every lender has kicked the can down the road another 12 months on these deals. and it is still hard to price these deals. So, like you said in the 80s, like I wasn't around in the 80s, but what happens? How long can you do negatively levered deals, right? Because when rates are, let's say, 5 to 5.5 right now, and A class deals into like there was a deal last week, A minus deal built in the 90s, 2000s, $50 million here in Dallas, and it was 36 offers, and that was on a 5 cap. Like, and you might be positively levered, but barely. So how long can we keep going at neutral or negative leverage? And does it make sense to step in?
The first 15 years of my career was at negative leverage. The issue is not negative leverage, full stop. The issue is those bridge loans were a Ponzi scheme. The sponsor really wasn't creating value. The sponsor was putting lipstick on a pig largely and hoping and waiting for interest rates and cap rates to come down and creating profit for them so they could go do another deal and call themselves masters of the universe. They've been found out. So the biggest issue every lender has today is which one of their sponsors do they want to bank and which one of their sponsors do they want to see dead. And it sounds a little harsh, but the problem in the capital markets right now is not negative leverage. The problem in the capital markets is, did the sponsor actually have a real plan? Was he really creating value? Was there excess space in a marketplace, or was this just a Ponzi scheme, a fix and flip kind of game? Again, I'm coming down harsh because it's dramatic and it's straight theatrical, and it makes the point. Negative leverage is not the issue. The issue is, can you identify, assess, mitigate, and price risk? If you can do that, and you have a business plan that is creating value, the issue of negative leverage gets paid off, if you will, on two counts: amortization, which I know no one wants in negative leverage, but also at residual at the back end of what's being created. And over time, cap rates will come down. My view is, in the 60s, in the 70s, even in the 80s, you had sponsors and developers who actually had a sense of what value would be. And today you got a bunch of cocktail goers who are afraid to put a bid in because their neighbor may suggest that they overpaid or they mispriced or they need an appraisal or they need their mother to approve that, or they need a doctor's note to stay away from home. It's silly. If you have a view of value, then your cost of capital is just turbo fuel or friction to creating that value. It's not creating the value.
We don't have a lot of long-term holders these days. If you go back, and I agree with you, back in the 70s and 80s, it used to be 3 rich guys or gals buying properties. And for the last 10 years, it's been 75 independent syndicators, non-related syndicators that are buying these properties, that are putting in equity into these deals. How can we get back to the times, which I agree with you, that people's rationale not to only stay in for 3 years, but stay in for 10 years, 11 years? How can we get that thinking back to into the marketplace itself to hold on to these properties?
I think it's a great question, Paul. And in the end, the answer to the final exam. My view is we need that. So how many of those 75 investors really understood and wanted to be in real estate, and how many of them had a fear of missing out? It's interesting. My dad, who passed a couple of years ago at 93, was never really focused on IRR. He was focused on positive leverage, but he was focused on monthly cash flow. So I, in particular, and one of my children are out looking for assets that we think will stand the test of time, where we can get real cash flow and build a portfolio of cash flow. There's 3 types of sponsors today in the marketplace. There is the sponsor who has never been through a downturn. There's the experienced rich sponsor who has a wonderful portfolio of multiple properties that are cash flowing. And he really, I don't want to say doesn't care, but one bad deal or 2 bad deals don't really bother him because he's got enough portfolio cash flow to work through it, right? All real estate makes money. The only question is who owns it at the time. Because the third category of sponsor is the guy who shouldn't have been here in the first place, who's in denial. Oh, yeah, rates will come down. Trust me when I tell you, the only people who want interest rates to come down are the existing owner of assets. All the people with dry powder who are willing to hold on longer, let's keep these rates up. Let's wipe out some value. Let's come in and get this great asset at a reduced price. And I just think that people have to really ask, are they in this? I mean, since 2017, I've been hanging around the hoop on some fintech stuff and property tech, and it was interesting, and I threw some money in, and I lost some money, and I had some, weird wins. And you know what I concluded? I'd rather be in a real estate deal for 10 or 12 years than one of these shitty fintech deals. And so I think investors got sold a bowl of goods, not because these were bad people, but for 2 or 3 decades, everything went lower interest rates, lower cap rates, values went up. It was kind of easy. I have a daughter-in-law who wants to buy a house. Why do you want to buy a house? Well, because everyone makes money in housing in California. Really? That's your reason? Yeah, I don't think we should do this. So again, I think there's this, just like the headlines are saying markets are bad and the world's coming to an end, and I don't agree. I think that too many people believe real estate is an entitlement, that it goes up and to the right at all times. And so I just think people have to decide what they want to do. They got to find the right sponsors who are in fact creating value. And I was talking to one rich guy who said, you know what, I'm going to change my thesis. Instead of making a lot of bets that are small, I'm going to make fewer bets with bigger checks. Well, that's interesting, right? Because if everyone had, I'm making this up, a syndicated deal where an investor, an LP, was putting between 250 and 500, and he went into 10 or 20 deals, wouldn't he be better off at $1 million to $5 million in a quarter or a fifth of the number of deals?
Yeah, so I mean, you're wanting to stay in deals longer, but how does a sponsor keep the lights on for 10 years? Because majority of their upside is coming when they sell that deal. So as soon as they have any equity, once they've hit their business plan, quote unquote, and they want to be out the deal in year 3 or 4.
Yeah, this was a misalignment of interest. Think about this for a second, right? And I have this discussion all the time. Is your business an operating business that you run revenue and expenses at profit? Or are you just a deal guy who's marking up the deal for an acquisition fee, a finance fee, and an exit fee, and a promote? So you got no money at risk, and you got a piece. How does the guy keep his lights on? He should not. He should go home. Let the rest of us come in, take his position, put money in the property. That's the winning bid. Is these guys need to die. The syndicator, the TIC guy, the DTC guy, gone. Let's go back to real developers in real locations that put real money in deals, and they have alignment of interest with their long-term capital partners and build real value. This has been a Ponzi scheme, a game of musical chairs that no one got caught on. And again, I don't know any of the borrowers you're talking about, but syndicators, you guys, Paul will know, but the 2 biggest syndicators in the 80s, 70s and 80s were JMB and Valcor. Valcor was a joint venture between Fidelity Mutual Life Insurance and a guy named Jerry Reinsdorf, who you would know today as the owner of the Bulls and the owner of the White Sox. Okay? That's Valcor. JMB, Jellison, Malkin, and Bloom, their progeny in business was companies you know today as GEM and as Walton Street, right? The syndicator's business ebbs and flows based on how dumb the LP capital is. And there are companies that generationally had dentists and lawyers and doctors that were putting $25,000 and $50,000 into a particular transaction. That business is not sustainable. It ebbs and flows. And guess what period of time it ebbs? Negative leverage. So there's a time and a place for the syndicator and the syndication. But I think these guys who are worried about keeping their lights on should sell their property. They should take a reduction in value. They should go out, go find something else to do, start over with a new deal. And the guys who put the real money up will make a new deal with the new guy who comes in. Working on a deal. I'm in a fund. I put a little bit of money in. I sit on the investment committee, and there was an apartment deal in Brooklyn. Big deal, $150 million deal. And the fund wanted to help with a recap. And when they brought the deal just casually to me, what do you think? I loved location. I even loved the sponsor. I loved everything about the deal. What I didn't like was the capital stack. And I said, you guys need to put more money into this. You need to change your business plan. And you need to go back to the first mortgage and start to make a deal with them because you're putting so much mezz preferred capital into this deal. And now the sponsor will subordinate their position to your position, and you'll create some value and some time by remaking the loan with the first mortgage. Because, James, one of the antidotes to the problem is a lot of these 2 and 3 year sponsor guys didn't make a deal with a life company. They made it with a debt fund. And the debt fund leveraged their balance sheet. So they got sucked into the same Ponzi scheme. The difference is the debt fund's going to get their warehouse line pulled. And so those guys can make a deal with somebody who will come in with some money. But I got no empathy for guys who say, well, how do I keep my lights on? I don't know. How do I keep my lights on? Right? Investing in a transaction has nothing to do with whether or not he keeps his lights on. If his business plan was flawed, then that's his problem. I'm happy to help him solve his problem, but not on this transaction that I put money in. Does that make sense?
No, I got it. I think the question for a lot of these guys is that you've been in the space for more years than I've been alive. So this was a quote that I saw just this weekend. And when you're talking, I think it hits it perfectly on. And here's a quote. It says, mastery is the best goal because the rich can't buy it. The impatient can't rush it. The privileged can't inherit it, and nobody can steal it. You can only earn it through hard work. And mastery is the ultimate status. And I feel like you have seen enough and you've seen enough deals go bad that you can speak directly to the problem. But a lot of people, they've only just started in this business in the last 5 years or 10 years or even less. And so they can't see it. All they see is, hey, I was getting 0% at the bank and you're offering me 5. That sounds a million times better than 0. And
so it's funny because at some level, I say there's only 3 things you have to do to be successful in any business. You have to do it every day. Acquire skills, accumulate experiences, develop relationships. You know what those 3 add up to over time? Mastery. But the bridge between mastery and those 3 skills is bad judgment. Bad experience is because of bad judgment. But through that experience, you can learn from it and develop good judgment so that you have better experiences. True story. You don't really know how long you're going to live. All of a sudden you have children. And I had in my will that if I died before my children were in their 20s, when I died, 10% of what they were going to get was going to go to them unfettered. And the rest was going to get set aside for a third releases at 35 and 40. Why? I was praying from the grave that they would piss away the 10%. How are they going to learn the lesson? Right? So those people who had money and weren't making and they went and stretched for deals that maybe they didn't understand, that will be a great learning experience for them. And it will change the way, look at it this way. Wouldn't you rather have this lesson than same scenario, except you're 55? Because at 55, you don't have the same window to make that money back. Whereas 25 to 35, if they lost a little bit of money but learned a big lesson and the marketplace reset around them and the rules changed, I'd rather be tomorrow, like 2025, where assets are and education experience is, than for this run-up to continue, 20, 21, 22, 23, 24. Because all that was really happening is it was making it harder and harder for young people to attain wealth. This reset and this partial education is the opportunity to create wealth.
Partial education. I like that one. So we talked, you've been in the business for a long period of time. The companies that you've worked for have been hugely successful. So you have a level of knowledge that a lot of people do not have. We reflect on 2024 going into 2025. If you have $100,000, $500,000, $1 million, if you want to be a real estate investor, you made a huge run up in the stock market. Now you want to pull it back and you want to put it into investing. What are you looking at right now? What would you advise somebody who wants to get in and be a real estate investor?
This is just kind of my view, and this is an old guy view. I think that I would want to invest with somebody who'd been through a cycle or three. Second, I would want, I'm a big proponent in brokers, big proponent, but a broker who only knows how to send out 125 OMs, I don't want to have anything to do with, right? I want a borrower who knows his deal and knows his market and knows his sponsor. So if I have an intermediary who's competent, okay, if I have a sponsor who's been through a cycle, then my job as an investor is at some level, do I have a view about the business plan, right? Do I believe in the business plan first? Second, do I believe in the sponsor's capability, capacity, and willingness to execute on that business plan? I think if you can do those things, whether you start small and spread it, right, and think about it as an education, or whether or not you really got lucky, do I mind giving somebody a promote? Oh, like they found the deal, right? They're managing the deal. Will I pay for an acquisition fee, a finance fee? Yeah, absolutely. But not because somebody's lining their pockets and trying to have nothing in the deal. What I really want is a view that A, there's alignment of interest, but B, this is a skilled guy who's got history behind him and that he has the capability, willingness to, and capacity to execute. And I know it sounds easy. I'm not finding as much as I want. There's a workforce housing problem in this country. It's acute. I live in Aspen. It's acute in the resort towns. I got a buddy from Dallas who moved up into the mountains, and we have been buying up condos and single-family homes to rent to the local community. There's a little bit of feel-good. There's a little bit of cash flow, but my hope is if I can build a big enough portfolio, one of two things will happen. Somebody will buy the portfolio from me, or I'll start selling these off at a higher valuation. But we've only been in the deal, I think, in the last year. I think we're in our first year, and I think we're about to buy our fourth home. I buy people, right? I suffer fools poorly. Oldest rule in the book is never bullshit a bullshitter. I can out-mind fuck any of you guys if somebody wants to mind fuck me first. So I just think you got to have a good nose for who knows what they're doing and who's full of shit, and you got to be willing to make mistakes.
Let's talk a little bit about your book that you wrote. I haven't had a chance to read it, but I think a lot of people would learn from it. The book is called The Freedom Frameworks. Freedom
Frameworks. Yep.
Talk a little bit about what that is and how that applies to everybody.
Thank you for asking. I wasn't intending to shamelessly pimp out my book, but I've been doing roundtables for 40 years in private and in public. And half a dozen years ago, I got this idea to start doing roundtables with young professionals. And it was super cool because I learned a lot. But one of the things I picked up was a third of the questions from the group revolved around career. And it dawned on me that people were still motivated to advance their career and still making money, wanted to make more money, but wanted more freedom and independence. And so I thought, okay, what if I could curate kind of pearls of wisdom? And so what I did is I collected since high school, since middle school. I have been collecting soundbite stories, frameworks. Some I've made up, some I stole, some I have gotten from others. And I tried to organize 50 or 60 frameworks into a career self-management playbook because my writing coach said I had to target it to somebody. So I said, I'm going to target it to the young professional, 25 to 35-year-old, because he really wasn't getting great career management advice because whoever he was working thought that employees were indentured servitude. What do I think? I mean, these are frameworks that I use to manage me, to manage others, to manage teams, to manage businesses. They have worked for me. I wanted to get them out. I've packaged them in the context of how to manage your career, but these frameworks are how to do strategic planning and time management. And I tell the frameworks through stories of my professional life. And I also tell them through, is it allegories or metaphors? But I tell stories about my kids. They're all true stories, but I lay out the framework in some funny vignette that happened to everyone. And, Scott read the book and he thought it not only helps the young professional, but somebody trying to figure out how to scale a business, somebody having trouble with salesmen. Who imagine managing a group of brokers would be hard on the guy running sales. So I put in a bunch of stuff in there, and I tell stories about my own failures, mistakes that I made, and what I learned from them. Will I make any money on this? No. Do I hope that it gets out there because it'll be a playbook that I think people, can relate to? That would be terrific. And if like this, I get a speaking assignment or a consulting assignment to help somebody, I'm happy to do it. I really am.
That's fantastic. If people wanted to get the book, what's the best way of getting that book and maybe getting a hold of you?
The book is on all the platforms. So the people have been buying most on Amazon and Barnes & Noble. It's Freedom Frameworks, and it's Jack M. Cohen. There's a subtitle about infinite possibilities. So it's out there and it's available. It's J. Cohen, COHEN, at darkknightventures.net. So Batman, Dark Knight, 2 Ks, Ventures, plural, .net. And my phone number is 312-543-5872. I'm available. I mean, do we have to work the schedule? Yes. Am I spontaneous? Absolutely not. But am I available to help? Sure. But, again, I'm not a wizard. I think that life is a to-do activity, not a to-think activity. If I can help you optimize the journey, I will. But the fact of the matter is you got to be on the journey and you got to be able to do the work. And there aren't any shortcuts. James, your quote to mastery, which please send me, I'll steal. I will footnote you 3 times. 4th, it's mine. But if you send, the key to that is at bat. This is a business that there aren't any real shortcuts. The best deal guys have seen the most deals, and that's how they know what value is. Kind of not a great game for the rookie player. But if you're going to work hard and hang around the hoop with old people and ask them questions, do it.
Some great information from Jack Cohen and the Cohen Financial, major players in commercial real estate finance for the last, say, 35 or 40 years. They did a wonderful job. We competed against them all the time. Jack, thanks for spending some time with us today. I learned all the time some great information from a lot of people that were in the trenches back 35 years ago, because we're going through it again on the repricing of the assets. So thank you very much for spending some time with us. James, anything more to add?
Actually, I had one more real quick.
Okay, go ahead.
Jack, I know you had 3 things, and one was like you should have never gone in business with your dad. But did you say your sons working together? You're working with your son together? Is that right?
No, very good. At least you're paying attention. I said I made 3 great mistakes in my life, and the first one was going to work for my dad. I've reversed that, is that I'm happy to support my children. I have a son who is 30 years old. He's in the business. He works for one of the debt funds, and he is doing a great job and loves that firm, but is looking to build his own real estate investing career and platform. And so to the extent that he and I can look at deals together, they're his deals, not mine. And
you're the silent LP. You're the silent LP, right? No, right.
Well, I'm not silent, but I'm often wrong, but never in doubt. And so yes, he has to endure my old guy thesis but yeah, I'm here to support him and his aspirations, not the other way around.
And one more. So I've only really lived through one big recession, which was sort of 08, 09. If you had to put us at what year, compare that recession to right now, what year is it in that recession right now?
I don't know that. It's a great question, and I'll give you an answer that you didn't ask for. I just think this is a nominal parking lot speed bump.
So it's
right?
like 12? Like, are we already just down and back already? Like,
yeah, I don't know if we're in a recession. I'm not an economy kind of guy. I try and steal sound bites from other people. But my view is what's been painful about this, unlike any other of the things we've gone through in the real estate business, is this has been a slow bleed out for like 18 to 24 months. So I really do believe we're at the end of that. I really do think there's a little bit more pain and suffering. I call it double dribble, on the bottom the rest of this year. But I would be doing my push-ups and sit-ups and my endurance training to be ready to rock and roll in January. And I think there will be phenomenal opportunities. I hope we have time for this story, but you'll get the joke. A guy named Luis Gonzalez, who wrote a book called Deep Survival. He was fascinated by 9/11, where 3,000 people died, but 3,000 people lived. And so he started doing studies on big, catastrophes, aviation accidents, and boating accidents. And survivors, here's the punchline, survivors are the ones who give up their mental memory of the future. Go into 25 with a fresh view of what a future should be. Do not go into 25 looking back for what it was in 17, 18, 19 in the past. Those people will lose their position at the table because the new people who are trying to create value or trying to look at it differently, try to understand it intrinsically, this will be a vibrant market no matter what, if you're willing to take what's there. If what you're waiting for is manna from heaven, it might come, it might not. So give up your mental memory of the future. You like that one?
That's a good one. James, anything else?
I'm good. I appreciate you coming on, Jack.
Well, we're going to have Jack come back another time to spend another hour, because I like Jack because I just say, hello, Jack, and then he's off. So I love that. He knows the topic as well as anybody, better than most. So thank you very much, Jack, for spending some time. James, thanks again. Get on Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.